Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to be showing you a simple option strategy that can be used, especially if you're new to options trading, and particularly well if you're trading with a small account. Now, if you guys are new to options trading or you're trying to use options trading in order to make some additional income to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, this is going to be part 2 to a previous video I did before. Now, this part 2 video is going to be super exciting, and as usual, we're going to go ahead and get down and dirty with options, meaning I will give you a step-by-step walkthrough of how to implement this strategy in order for you to make some serious gains as soon as you execute the trade. Now, because of the overwhelming response that you guys gave to part 1, I've decided to go ahead and make part 2. Now, there is a part 3 to this. Now, the part 3, I'm going to give you a warning right now. With part 3, the gains are going to be way higher, but the risk to reward is going to be way lower. If you guys are interested in seeing me make a part 3, then it's quite simple. Go ahead in the comments below and just simply put in part 3, and I have no problem going ahead to make that for you guys. Now, our video for today is going to showcase the Spider ETF, and that ticker is going to be SPY. So let's go ahead and get down and dirty with options. So firstly, we're going to go ahead to trade SPY options down in the bottom in order for us to open up this option chain. Now, this area down here in its entirety is the option chain. What the option chain does is that it gives us enough information in order for us to make an informed decision before getting into any options contract. Speaking of getting to options contract, I do have two requirements before I continue this video. Requirement number one is going to be always make sure to do your own due diligence before investing. What might work for my portfolio, quite frankly, may not work for yours. Requirement number two, always make sure to have an exit strategy before entering any options trade. That way, if the trade does decide to go against you, then you're able to get out of the trade. And do not worry, I will show you the exit strategy for this particular option. Now, let's go ahead and go to sell. We're gonna go to call, and now we're gonna go ahead and choose our strike date. The strike date I will be going with is gonna be July 10th, and that gives me 7 days to expiration. The reason why I'm going with July 10th with only 7 days, because if you're new to options and you're working with a small account, you do not need a long expiration date because your capital is gonna be tied up for way too long. Hence, only 7 days, or you could call this weekly expiration every 7 days. So now that we have sell and we have call, and we have our weekly expiration date, we're going to go ahead and choose our strike price. The strike price we're going to be choosing is going to be one above the share price. As you can see here, the share price is 621 or thereabouts. So let's go ahead and go up in order for us to choose it. Now, the price I will be going with is going to be the $629 strike price. The reason for me going to the $629 strike price is because I'm simply looking for a chance of profitability of 80% or higher. That being said, I can use the 628 or I can use the 629, but I'm particularly going to use 629 in order to show you guys something later on in the video. So with an 83% chance of profit, my strike price is going to be 629. Now, this is the first part of the two-leg option strategy, and this is going to be a sell option. Now, because we are selling, we're going to be receiving some kind of income. The income we're going to be receiving, let's go ahead and click right here. The income we're going to be receiving is going to be $1.06. In the real world, that's going to be $106. And that is simply because each option contract does contain 100 shares. So you simply multiply your $1.06 right here by 100 shares, and you will be getting $106. Now, what we're going to do, and make sure you pay attention, I don't want you to get confused. Now we're going to go ahead and we're going to implement the second leg of this two-leg option strategy. So let's go ahead, we're going to change the parameters to the top by going to buy. we're going to maintain our call and we're going to maintain our exact same strike date. If you do go ahead and choose a strike date, this is going to be a completely different option strategy. And I will show you how to confirm that you're on the right track. So now that we have buy and we have call and maintain our exact same strike date, we're going to go ahead and choose a strike price immediately above our previous strike price. So we did choose the 629 previously. Now we're going to go with the 630. The criteria for choosing the 630 is quite simple. You just go ahead and choose the one directly above the previous one. We're going to go ahead and we're going to select that. Now, this second leg is now a buy option strategy. And because it's a buy option strategy, we're going to have to pay. The amount we're going to have to pay is going to be 0.86 or 86 cents. Now, bear with me. The difference between your sell leg of your 629 and your buy leg of your 630 is what's going to be known as your options premium. Let's go ahead. We're going to hit continue. And the premium you're going to be receiving is going to be $21.92, or we're going to round it up to $22 just for this video. Let's go ahead. We hit review. I'm going to walk you through the trade. But before that, this option strategy that works particularly well if you're new to options or you're trading with a small account is going to be known as the call credit spread. So that is how you know if you're on the right track. If this up here says anything different, you're on the wrong track. So go ahead, replay the video and do it step by step. Now, before I continue, on this channel, I am allowed to show you option strategies. What I cannot do is show you actual trades. So this is not an actual trade. And remember, always make sure to do your own due diligence before investing. Now I'm going to go ahead and walk you through the trade. So with the call credit spread, the reason or reasons rather why it's so perfect if you're trading with a small account is that the barrier to entry is quite small. In order for you to do the call credit spread, you need to leave a collateral. The collateral you're going to be leaving is going to be $100. I mean, if you're watching this video, you should have $100 in your portfolio. And if you don't, you need to really step up your money game. So anyone trading with a small account with a couple $100 can go ahead and do this option strategy. The other reason why the call credit spread is absolutely awesome if you're trading with a small account is because it allows you to grow your small account by receiving income. As soon as you decide to execute this option strategy, you're gonna be paid. The amount you're gonna be paid is gonna be this $22 right here. Here's the kicker. This $22 here that you receive, that is absolutely yours no matter how the trade goes. And this $22 here is what allows you to grow your account portfolio by compounding. Now, how does this trade work? I'm pretty sure you want to know. So, come expiration date, this is how this trade goes. And before I show you how this trade goes, I want to let you know this option strategy, the call credit spread, is a bearish option strategy. So by implementing a bearish option strategy, you're of the mindset that this share price is going to be below your strike price that you chose, or it's going to be trading sideways, or it's going to be going downwards. So this is how this option strategy could go. So come expiration date of July 10th, if this share price right here is trading anywhere below your $629 strike price, then voila, you have won the trade. Once again, you're going to get to keep your $200. Remember, we did say that's yours to keep no matter how the trade goes. But in addition to that, you're going to get your collateral released back to you. Remember, in order to do this trade, you had to leave a collateral of $100. So now you get $22 in order to compound and grow your portfolio. And now you have your $100 back in your portfolio in order for you to go ahead and do this option strategy or another option strategy, probably use another stock. Now, the call credit spread is best done with ETFs. Now, there are 3 ETFs that are the absolute best in order to do this option strategy, and that's going to be the Spider ETF. That is the one we're using right now. Ticker is SPY, the IWM, or the QQQ. So remember that the Spider ETF, the QQQ, and the IWM are the best ETFs in order for you to go ahead and perform the call credit spread. Now, the other way that this trade could go, come again, expiration date of July 10th. if this share price right here, if your 621 share price now goes above the $630 strike price, then once again, you're going to go ahead and keep this option premium. Remember, that is what allows you to grow your portfolio, because as soon as you do this trade, you get money right away that you get to keep. Now, although you get to keep your $2,200, you're going to be losing your collateral. Now, the collateral you're going to be losing is going to be $100, but that is not the entirety of the facts. The actual amount you're going to be losing is going to be the amount of money you receive, which is going to be the $22, minus you're going to subtract that from the collateral you left, which is the $100, and the amount you're going to be losing on this particular trade is going to be $88. So I think this is a pretty good trade because of your risk to reward. Let me show you why. By receiving $22 and risking only $100, your percentage return on this trade is going to be 22%. Now, 22% is an excellent gain for just doing a trade for 7 days. This option strategy allows you to lose up to $88. So it's not going to allow you to blow up your account. This option strategy also allows you, if you have a couple of $100, to trade this particular setup, because you're only going to be risking small amounts of money. So if you're new to option strategy and you're trading with a small account, then you should definitely consider the call credit spread. Now, for those of you guys that made it to the end of the video and you did go ahead and watch part 1 of this video, I have an update for you. As of making this video, the Spider ETF is currently trading at 621. When I made that video, the strike price we chose was 609. That means in 2 days, you should be up on that trade. You should be up probably more than 75% on the trade. I did mention at the end of the last video, and I'm going to mention it here again. With these options spread, it is highly advisable that you close your trades before expiration. Trust me, I've been doing this for a long time. Always close your trades before expiration. You do not have to close all the option strategies, but for spreads, you would need to close it before. Now, so there you guys have it, investors and future investors. That is going to be the call credit spread, and the call credit spread is a bearish option strategy. Remember, by doing a call credit spread right now, you're going to be going against the market. The reason why you're going to be going against the market is because right now we're in a bullish uptrend. So remember that. Now, I did show you in the last video how to mitigate your risk, or if you want to increase your capital. So please make sure you go ahead and you watch part 1 of this video. And lastly, if you guys want to see me make a part 3 of this video where you're now able to make even a higher percentage gain and you have a very much better risk to reward, then go ahead and just type in part 3 in the comments below. I have zero issues going ahead and make that video for you. Now, go ahead, like the video, subscribe to the channel. Make sure to hit that notification bell to get an alert when I post a video. I thank you guys so much for your response to my last video, and I'm going to continue giving you as good content as I possibly can. But this is why I make these videos. I absolutely love making these videos in order for me to help as much people as I can make income from options, in order for them to supplement their regular 9 to 5, or after a couple of years, they're able to leave their 9 to 5 in order to just trade options. So if there's anyone out there you know struggling to grow a small account portfolio, then the right thing to do is to go ahead and share this video with them. We're trying to help as many as we can. Now, until the next video, keep pushing your investments.